Today we will proceed to Chapter 4, Securities Markets. Today's agenda is first we will cover the transfer of funds from savers to businesses, markets makers and brokers, the mechanics of the investing in securities, measures of securities prices, foreign securities, competition in securities markets, and we'll wrap up. So as you remember the players in the diamond, we have savers, savers and borrowers, and indirect transfer from savers to borrowers through a financial instrument, and direct transfer from savers to borrowers through financial markets. We cover the investment banks, brokerage firms, hedge funds, angel investors, and the VC, venture capital investors in financial markets. And we talk about the financial institutions, and we talk about indirect transfer and direct transfer. And as you remember, we have a direct transfer, and in the direct transfer in financial markets, we have IPO and secondary market offerings, and stocks can be traded in New York Stock Exchange and Nasdaq. But today we will proceed to the financial markets and how they operate. So the primary function of a stock market is not to raise funds for firms, but to transfer securities from sellers like you and me to buyers like you and me. So there's no net change in number of securities in existence. No funds are transferred to firms in the stock exchange. So there's no net change in the number of securities in existence, and no funds are transferred to firms. All that occurs is a transfer of ownership from the sellers to buyers. Stock markets are secondary markets that facilitate the transfer of existing securities among investors. This transfer is extremely important for owners who know a secondary market exists in which they may sell their securities. This ease with which securities may be sold and converted in cash increases with the willingness of the investors to buy and sold stocks and bonds, and thus increase the ability of firms to issue securities. Without the secondary markets, investors will be reluctant to buy the shares when a firm initially issued them. So this chapter considers the securities market, especially the stock market, the mechanics of investing, the role of brokers and securities dealers, cash versus margin accounts, long and short positions, and foreign securities. Foreign securities are covered. The chapter ends with a discussion of the efficient market hypothesis, which suggests that over a period of years, few investors will outperform the markets. So, market makers, the millions of shares and the billions of dollars change hands every day in stock exchanges, such as New York Stock Exchange and IMEX, or over-the-counter markets, example OTCQX. And the buyers and sellers never meet. Instead, the securities markets impersonally transfer the stocks and bonds from the sellers to buyers. The transfers may occur on an organized exchange, such as New York Stock Exchange, or through an electronic market, the over-the-counter market. While there are organizational differences between the exchanges and OTC markets, from your perspective as a potential investor, they work essentially the same. And suppose you want to buy a stock such as Apple, and Apple trades through the New York Stock Exchange, and also you want to buy Amazon, and Amazon trades through the OTC markets, over-the-counter markets. But in either case, you buy the stocks through a brokerage firm, through a broker. The broker does not actually sell you the stock, but acts as our agent. The stock is purchased from a securities dealer, even if you use a discount, a brokerage firm, or buy and sell online through the internet, like Robinhood or other platforms. The stock is sold to you by a securities dealer. The Securities and Exchange Act of 1934 defines a dealer, um, a market maker, as anyone who engages in the business of buying and selling securities for his own account. So every New York Exchange stock has a designated market maker, or DMM. The designated market maker supervises trading in a company stock to ensure that trading, buying or selling goes smoothly. If trading were to become volatile, the DMM, the designated market maker, will step in and buy or sell the securities for its own account. So there's some financial institutions in the market, such as New York Stock Exchange, DMM. They are selling uh, and buying securities in order to um, function market smoothly. So they act as buyer if you want to sell, and they act seller if the investors want to buy. Want to buy. And market makers set specified prices at which they will buy and sell the securities. For example, a market maker may be willing to purchase a stock at $20 and sell it at $21. The security is then quoted 20 to 21, bid and ask, these are the bid and ask prices. So the bid and ask prices quoted by market makers at which they are willing to buy and sell securities. They um, the market makers set the bid and ask prices, and investors can buy in 21 and sell 20. And Nasdaq, although Nasdaq operates as a dealer network, Nasdaq stocks are generally not classified as OTC because the Nasdaq is connected to the stock exchange. Um, so brokerage firms, um, they are our agent that buys and sells stocks from a securities dealers in our name. So if you want to go and buy a stock in New York Stock Exchange, first you need to have an account in a firm, brokerage firm, and in the brokerage firm, broker take your order and execute your order. This is one option. Physical, you can just dial them and call them and ask them to buy securities to buy or sell, or you can have again an account in a brokerage firm, and you can just give order through internet, and you just buy stocks online. Again, same using the brokerage firm account. And market makers buys and sells stocks for its own. So in the market, um, as I said before, the market makers, these are the institutions, they are responsible to operate the market smoothly, and they just they just execute your orders depending on uh, the price level. So every stock has one DMM, designated market maker. And what is the spread? How does the dealer make money? So there is a bid and ask price, so bid price and ask price, and let's say $20 for stock ABC, and $21 for ABC. Okay, same stock, and we have bid and ask prices, and the difference between bid and ask price called spread, and they make money um, um, from this spread. The difference between the bid and ask spread is cost of us and gain for the DMM. And stocks are transacted in lots, and run lots, normal unit of trading in a security, and usually it's 100 stock. And odd lots is different from 100 stocks, usually less than, like 96 or 55. Okay, so market makers facilitate securities transactions. They do not set the level of prices, and price is determined by the supply and demand for the securities. So the mechanics of investing in securities. Um, After deciding to purchase a security, you place a purchase order with a broker house, whose role is to buy and sell securities for customers. The broker and market maker should not be confused, since they perform different and crucial roles in mechanics of purchasing and selling securities. The brokers execute orders for customers. Securities dealers make a market. They buy and sell securities for their own accounts. Okay, and market order is an order to buy or sell a security that at the best current price. Market order, current price, and executed at the current bid and ask and assured transaction. Limit orders, they specified price. It could be day order or good till cancelled order, and transaction may not occur if the price level does not touch the price level that you want to sell or buy. Let's say you give a limit order $10, but the now bid and ask price is you want to buy a stock $10. Ask price is now $12, and the bid is $10, and you give it a limit order, and you want to buy stock at $10, and but now the price is $12. The price can go down or up, but if it doesn't go down, you cannot get the price. So it's not certain you will get the price. You will get the stock. Other items, you need to pay commissions, and the settlement date, it differs for different stock exchanges. It could be T+2 or T+3, meaning that you buy the stock. Let's say you buy Apple stock at time T, but you will own the stock at time T+2, meaning settlement date is T+2, you will own the stock at T+2. This is the confirmation statement of a security purchase. You will see how many stocks you bought, and the price level, which company you bought, and Cleveback Corporation stock you bought, and this is transaction number. CUSIP number is linked to the company, so every company has different CUSIP number, and this statement shows no interest, and commission is 51, and total amount is 1,264. Okay, what is margin accounts. The margin is investors' equity in a security position, and margin requirement is a minimum percentage set by the Federal Reserve of the total price that must be put up to buy securities. Meaning, margin requirement is the minimum percentage of the total price that you must pay to buy the stock. So margin is the amount of equity you have and the total value of portfolio you have divided by the total value of portfolio. Let's say you have $10,000 equity in your account and you bought $2,000 worth stock. So that means your margin is 50% margin. Margin requirement is a minimum percentage you must pay in cash. You can borrow the rest from the broker and pay interest. We will have a problem. We will solve a problem regarding this margin requirements. And let's say if the margin requirement is 60% and the price plus the commission on 100 shares of Cliff Park Corporation is 1,264. The investors, so you buy 100 shares, multiply by the price of the Cliff Park Corporation, which equals to $1,264. If the margin requirement is 60%, that means at least you have 60% of this amount in your account, meaning you need to have $758 in cash in your account. You may borrow rest of them. You may borrow the rest of the amount, which is $505.6. So margin call is the request of additional funds, meaning that same situation, you have the margin requirement is 60% for your account, and if you want to buy a stock or invest a stock and you don't have $758 in your account, you're not able to buy the stock. This is just a requirement that you need to meet. So example of financial leverage. Let's solve another problem. So you buy 50 shares at $20 and the margin is 60. The shares go up 30. And what is the return with no financial leverage? Okay, so the profit is you are investing, the price goes up 30 from 20, so $10. Okay, 50 shares multiplied by $30 is equals to 1,500, and you initially bought 50 shares, $20. This is initial amount you paid, and the price goes to $30, and the profit is you just 1,500 minus 1,000. your profit, and your investment was, the initial investment was 1,000, and you divided 1,000, and you find return on investment, which is 50%. What is the return depositing the margin and borrowing the rest? So let's say if the margin is margin requirement. Here is the margin is margin requirement. If the margin requirement is 60%, meaning, let's say, think about it in this way. If the margin requirement is 100%, and you want to buy 50 shares multiplied by each share is $20 and total $1,000 cost, you need to pay $1,000. Margin requirement is $1,000. The brokerage firm asks you, you need to pay full of cash, full of amount, and then you will buy. But you have you have higher credit score, and let's say, and the brokerage firm asks you the minimum margin requirement for your account is 60%. 60%, meaning if you want to buy $1,000 cost stock, you need to have $600 in your account. That's it, and you will borrow the rest of the amount, $400, and you can just execute the order. That's it. In that case, the return on investment has changed. Why? Because your initial investment has changed. Now you're not investing $1,000. Now you're investing only $600. Same profit, but small, lower initial investment. So your return is increased. Another terminology is long position, or bullish position, or short position, bearish position, meaning if you going long, meaning you purchase in anticipation of prices increase. The bull market, typically this time, price. The bull market, the trend is upwards, and people, and when you go the market and have a long position, long means you're buying, and converse situation, you think the price will decrease, and you want to sell the stock short position, and you think the price levels here, now we're here, time and price, and you think the price will decrease, and you want to sell the stock, and you have short position, you anticipate, and you expect in the future the price will go down, and you have short position. And there are plenty of indices in the market, and the Dow Jones Industrial Index, which is the most popular, one of the most popular indices, S&P 500, New York Stock Exchange Index, Nasdaq Index, Future Index, Russell 1000. Let's say Russell 1000 is the list of stocks, 1,000 stocks that includes in this index These are the largest 1,000 firms. Let's say Russell 2000, the index includes 2,000 next largest 2,000 firms. And Russell 3000, let's say Russell 3000 index, it combines the firms in the Russell 1000 and the Russell 2000. So the possible questions concerning what securities to include. So every index, each index has different stocks. So how they decide to include which stocks, depending on the market capitalization, the size of the stock, and how index is computed. Again, they're taking the largest stocks and they compute the indexes and can produce different measures of stock performance. Yeah, you don't need to look at predefined indexes, and you can calculate your index, and you can include only 10 stocks, and you can follow this index, whether it is that you just follow the performance of this index. So foreign securities, in addition to domestic securities, you may purchase foreign stocks and bonds in U.S. market. Foreign companies like American companies issue a variety of securities as a means to acquire funds. These securities subsequently trade on foreign OTC market and foreign exchange such as stock exchange in London, Paris, Tokyo, and other financial systems. Same occurs in U.S. markets. In U.S. markets, there could be some foreign stocks like Chinese stocks or German stocks can be traded, or U.S. stocks, Apple stock can trade in Europe exchange. So how can it be happen? Foreign stocks, it can be by using American depository receipts. The receipts issued for foreign securities held by a trustee. So in order to it avoids the problem of language expressed in dollars and not the local currency registered with the SEC. And American securities markets do not actually trade foreign shares, but the trade receipts for the stock called American Depository Receipts, or ADRs. And ADRs also referred to as American Depository Shares. Such receipts are created by large financial institutions such as commercial banks and then sold to the American public. The creation of ADRs greatly facilitates trading in foreign securities since prices are quoted in dollars and dividend payments are received in dollars. So it's simply ADRs, it's simply stocks, but if one foreign country, a firm coming from foreign country wants its shares traded in U.S. markets, they need to convert their shares to ADRs, American Depository Receipts. Same for U.S. firms. Similar by bonds sold in foreign countries, bonds issued by foreign firms, bonds issued by foreign governments, foreign countries by American firms. They called Eurobonds, bonds sold in a foreign country but denominated in currency of the issuing firm. So bonds issued abroad by American firms are basically of two types depending on the currency in which they are denominated. the American firms can sell bonds denominated in local currency, for example, the British pounds, or the firms can sell abroad bonds denominated in American dollars called euro bonds. This term applies even though the bonds may be issued in Asia instead of Europe. When an American firm issues a euro bond, it promises to make payments in dollars. In this case, the American investors will not have to convert the payments from the local currency, such as British pounds, back into dollars. So, last section for this chapter is the competition in securities markets. So, the economics teach that markets will be competitive if there are many informed participants who may readily enter and exit both the stock and bond markets. Meet these conditions. Individuals may readily buy and sell securities. Information is rapidly disseminated and prices quickly change in reaction to change in the economic and financial environment. The securities markets are among the most competitive markets in existence. So if competition is high, it's easy. It means it's easy entry and exit, sufficient liquidity, information disseminates rapidly, and prices change occur quickly. So this competition among investors has led to efficient market hypothesis, which asserts that securities markets are so competitive that the current price of stock properly values the firm's future prospects, meaning that the firm's future earnings and its dividends. If a firm's stock were perceived as undervalued, investors would rush to buy it, thus driving up its price. The converse would occur if the stock were perceived as overvalued, and the price will be driven down. Hence, the current price is a true measure of the security's worth. For the individual investors, therefore, security analysis is designed to determine if a stock is overpriced or underpriced is fiddle because the price is neither. So the efficient market hypothesis simply says that stock prices adjust so quickly to new information. Stock prices should reflect all available information, and investors cannot expect consistently outperform. And empirical results supports the efficient market hypothesis. There could be some anomalies, but in general, the empirical results supports the efficient market hypothesis. So an important implication of the efficient market hypothesis is that you cannot consistently beat the market, beat the market. Rather, you will earn a return consistent with the market return and the amount of risk you bear. The efficient market hypothesis suggests that the probability of your outperforming the market over any extended period is very small, and that does not mean you cannot outperform or underperform the market during a short period of time. During a brief period, such as a year, some investors will earn a return that is higher than the return earned by the market. However, there is a little chance that those individuals will be able to achieve superior results for an extended period of time. In other words, to outperform the market consistently. So one primary reason for the efficient market hypothesis is the speed with which securities prices adjust to new information. The efficient market hypothesis requires that prices adjust extremely rapidly as new information is disseminated. In the modern world of advanced communication, information is rapidly dispersed in the investment community. The market then adjusts securities prices in accordance with the impact of the news on the firm's future earnings and dividends. By the time that the individual investors has learned the information, securities prices probably will have already changed. Thus, the investors will not be able to profit from acting on the information. So simply, efficient market hypothesis says this is S&P 500 index, and you are you have a portfolio. This is your benchmark portfolio. This is the representation for the market. For the market, you cannot beat this index performance for a long period of time. No, they say in the long period of time you will follow quite same performance. So let's look at this chart. What we mean by the quick acquisition of news. So this is an example of daily price of VCA Incorporation prior and after announcement of being acquired by March 2017. This is the time of, here is the time of the news regarding acquisition. So if the market is efficient, we expect the price level is just here, and if the news just arrived in the market and disseminated very quickly and the price jumped to this level. If price adjustment, okay, if the market is inefficient, the price adjustment will be very slow and will come to the same level as efficient market in a longer time. If completely inefficient, maybe it goes this, maybe this. But efficient market hypothesis says that as the market is efficient, and meaning the stock price adjusts so quickly to the new information, and stock prices should reflect old available information. So the stock price reflect old available information at the time of the news for the acquisition. So let's solve one last problem. Okay. You purchase 100 shares of Apple for $100 per share. After a year, the share price goes up 120. What is the return on investment if you do not borrow funds? What is the return in the margin requirement? 60%, and you borrow the rest. And the other problem is same as before, but the stock price went down 80 instead of rise 20. Just pause video here and try to solve this problem, and I will solve the problem. Okay, the solution is you bought 100 shares. What is your cost? Each share is $100. Your cost is $10,000. And the margin requirement is for you is 60%. What does it mean? It means at least you have 60% of this cost in your account. What is the 60% of 10,000? Multiply 60%, 6,000. You have at least 6,000 cash in your account. Okay, so but you want to buy 100 share, you need to borrow. You need to borrow rest of it. So after 1 year, your investment 100 share, now the price goes up, the price 120, and the value of the stocks goes to 12,000. Let's find return on investment. Return on investment. Return on investment, you have numerator and denominator. Numerator is your profit. Denominator is your investment, initial investment. What's your profit when you invest without borrowing? Same, your profit is 12,000 minus 10,000 cost divided by your initial investment is $10,000, and your return on investment is 20%. For the second one, meaning by using margin, if you borrow money and your initial investment goes to 60,000, now your profit is same, but your initial investment is 6,000 and your return goes up. It's higher than the previous one, right? Because your initial investment is higher here. For the second, for the B section, now price, you bought 100 shares, you bought 100 shares, but the cost is $100. This is your cost, right? This is your cost. Instead of going up in 1 year, 100 shares, the prices goes down. Now it's 80. The value of your investment is 8,000. Same calculation. What's your profit? You don't have profit. You have negative 2,000. You have loss here divided by initial investment 10,000. So return on investment is minus 20%. If you borrow money and you use margin, depending on your margin requirement, you own only 6,000 and you borrow 4,000. What is your return on investment? Same, your profit and divided by initial investment. Now your return on investment, it's worse. So wrap up. We look at the broker and dealers, types of orders, investment margin and return calculation, and efficient market hypothesis. Please read your notes, the PowerPoint slides, and the chapter 1 and 3 and 4 from your book, and complete the mind tab exercises, quizzes, video reviews, PowerPoint, and flashcards. All the questions will come from mind tab exercises and quizzes plus the book, plus our book. Thank you for your attention. See you next time.